Hello and welcome to Reject Modernity, Embrace Tradition, where we take you back to the good old days, just maybe not exactly how you'd expect from our title. My name is Megan Cox.
And I am Clayton Becker. And we are coming to you from the day after Thanksgiving, coming to you on Black Friday. I feel like, Megan, we've done a lot of these episodes where we just jump right into the topic. And frankly, I feel like most podcasts don't do that. I feel like we should ask each other how we've been, and all that stuff. The problem is that I see you all the time in real life, and so it's just not normal, like how
There's not a lot of mystery here.
Yeah. But I haven't actually seen you since Thanksgiving. So how was your Thanksgiving, Megan? What did you get up to?
It was pretty good. I did not go home. I went to celebrate with friends, which is always kind of that like bittersweet mix.
Mm-hmm.
But I'm also very grateful to have not had to brave the travel situation this week. And so that is the gift of time that I am accepting this Thanksgiving.
All right, fair, very fair.
What about you?
We went back to Claremont, had Thanksgiving with Andrea's parents, and then they decided this week that they wanted to go on a trip to Cabo. And so we dropped them off at LAX this morning, which was fun.
Nothing like a command decision, just like, all right, bye guys.
I mean, it worked out just fine. So anyway,
yeah.
With that nice little preamble of making ourselves more of an official podcast out of the way, Megan, what are we going to be talking about today?
So, Clayton, I have asked you as our resident expert on all things housing to talk to us a little bit about the 50-year mortgage and why we should reject it.
A little bit is an understatement of how much talking about this I am going to do. But yes, at the end of last recording session, or during the last recording session or whatever, Megan was basically like, we need to talk about the 50-year mortgage. Please write
Yes.
up.
So today, it sounds like we're going to reject the 50-year mortgage and embrace building housing, which sounds like a great plan.
Yeah, we're going to reject the 50-year mortgage. There's going to be a lot of history in this episode. There's going to be some finance stuff. We'll try to keep it as high level, not too into the weeds as we can. But there are a number of important things to understand here. So we'll try to make it as clear as possible. If we're not clear, let us know somehow, I guess, right? Well, we can do it again.
Carrier pigeon, DM on the various platforms. I am occasionally on TikTok now.
All right. So the 50-year mortgage, such as we can call this an actual proposal from the Trump administration, we'll get into why that's even overdoing just how much of an actual thing this is. The 50-year mortgage is a terrible idea. It's just complete and utter nonsense. And we'll get into exactly why that is in a little bit. But before we do that, I think we do need to go over sort of the history and the backstory of both this proposal, such as it is, and the history of just how purchasing a home has worked, how it works right now and how it's worked in the past.
I'm really excited for this because if you're like me and despite having owned a home and had a mortgage, thought that the 30-year mortgage came down like Moses off the mountain on a stone tablet, this is fascinating information. There is no divine mandate that mortgages last for 30 years. So tell us about it.
Yeah, the 30-year mortgage is kind of a historical accident, quite frankly. The 30-year mortgage, it comes out of the Great Depression. It's fundamentally a product of the Great Depression. Prior to the 1930s, or really, I guess, prior to the 1940s is when this becomes sort of more official in law and statute. Mortgage terms were often much shorter than 30 years. The most common was actually 10 years, and it stretched to 15 years. They had higher down payments, and importantly, they mostly weren't what we call self-amortizing mortgages. And that's just a fancy term for... It's a fancy finance term that essentially means that the principal, so the value of the home, the actual amount of money you're borrowing, as well as the interest, which you can sort of think of as the price you pay for the bank letting you use their money to purchase the home, right? Those are paid off over the duration of the loan, wrapped up into one payment, right? So your mortgage payment, Megan, as a former homeowner, you'll know this, remember this, you pay one payment and that payment both has the actual interest and the actual principal wrapped up in it, right? It'll often, depending on jurisdiction, also have other taxes, HOA fees, property taxes, that kind of stuff. Like some types of insurance will be rolled into that payment as well. But all of this stuff is in one
I'm writing
payment.
one check every month, or writing one
Yes.
check, having one direct
Having one
deposit
thing,
every month.
one thing taken out of your bank account, right? So that's a self-amortizing mortgage. And that's what basically all mortgages are these days, where you pay off the principal and the interest at the same time over the course of the loan. You're paying off more interest at the beginning, more of the principal at the end. So you don't build equity, consistently.
You don't build as much equity as you could right off the bat.
Yes. But loans weren't like this, right? Prior to the advent of the 30-year mortgage. Instead, these old loans required that you pay the full value of the principal as a lump sum at the end of the loan term. And so this meant that oftentimes people had to take out like smaller second mortgages at the end of the loan term in order to pay off the first mortgage, right? And like obviously you can sort of
you have no equity then, right?
So you're like saving money over the course of the entire time that you're owning the property in order to help pay off this mortgage, right? The idea basically being that like the value of that property should go up. You might be able to borrow at more favorable terms. You're having higher income over the course of those 10 years, right? Like your income's growing. And so you can you don't have to take out exactly the same amount of money, or, the rate of inflation since then has made it such that the value of the property that you're paying off is less than the value of the property in sort of inflation adjusted terms.
But
There's
not necessarily. Like
Yes,
perhaps
exactly.
if there is, I don't know, a Great Depression that happens.
Perhaps, right? And so there's basically all of these like risks that are built into the old way that we used to do home loans, right? And so obviously this had a number of effects, but chief among them is that it really limited homeownership to a wealthier subset of the population, right? Far fewer Americans as like a percentage of the population actually owned their homes back in the pre-Great Depression era.
Now, dude, this makes the whole plot of It's a Wonderful Life makes so much more sense now.
I actually haven't seen it, so...
Well, okay. This is our seasonal hook, I guess. We just said it's the day after Thanksgiving. Clayton, go watch It's a Wonderful Life. Because, like, the part of it that everybody's, like, familiar with is we're going to run through how the world would be if you were never born. But also, meanwhile, the main character, Jimmy Stewart, is stuck working at a building and loan, like, bank, basically. And I'm like, why are people working so hard to buy houses? It's because you couldn't freaking buy houses in this setup.
I can tell you, this is a plot point I had no knowledge of.
Mm-hmm.
Like, these building and loan corporations are how people who weren't wealthy bought homes. Basically,
it makes so much more sense.
You'd have a lot of like sort of middle class or upper middle class people. They would pay into this. It's basically like a co-op, sort of.
Yeah. Yes.
And the fact that you're paying into it gives you the right to have some of the money that this building and loan corporation has. You can use that in order to purchase homes. Again, this is sort of risky. Like the building and loan corporation is kind of the alternative to your like typical financial institution, like a normal bank, right, or a credit union, right? It's the alternative to that, an alternative form of finance. Now, we can sort of talk about like what the optimal level of home ownership is, if there is such a thing. There's an argument to be made that actually somewhat lower levels of home ownership aid in labor mobility, which is really important for people to be able to like move to where the best jobs are, but whatever. That's sort of another episode, right? But the long story short, the too long didn't read on all of this, is that prior to FDR's presidency, far fewer people owned their homes than do so today. And the loans that were being made were really risky because, just of the way that it functions, right? All of these different the underlying assumption is that you're going to be able to pay off these loans because you'll be able to refinance, you'll be making a larger salary, your home will have increased in value, yada, yada, yada.
When you say risky, are you talking about risky to the individual or risky to the system, or both?
Both.
Okay.
We'll see as we go into the 30-year mortgage that the 30-year mortgage is way less risky for buyers, and actually I would argue somewhat more risky for financial institutions.
Okay.
But anyway, so you have all of these assumptions. That's basically like, if these things happen, you'll be able to pay off this loan, it'll be fine, right? And there's lots of reasons to assume that this was like a reasonable assumption, right? Like if any of those things, not just if all of those things happen, right? But then you have the Great Depression hits, right? In early 1930s. The economy stagnates, the financial system crashes, credit dries up. Like financial institutions of all types don't really have any money to lend. And this leads to widespread foreclosures, really widespread foreclosures. At one point in the early 1930s, more than 1 in 10 homes in the United States was in foreclosure, which is way higher than the number of homes that were in foreclosure even during the Great Recession, right? 15, 17 years ago, whatever, at this point. I don't have that figure off the top of my head, but it wasn't close to 10% of the entire housing stock in the country being in foreclosure. This is like financial Armageddon, right, when it comes to the housing market and private housing markets. 10% of the housing stock of the United States being in foreclosure, repossessed by banks, with no real credit markets, and no one having any sort of resources to purchase the homes from the banks that are in foreclosure.
Not that it's necessarily the point, but at the peak of the Great Recession, when it did feel like it was catastrophic, 4% of homes were in foreclosure in the United States.
So
I cannot imagine.
Less than half of the number that were in
I can't
foreclosure.
imagine. Yeah.
Like just total financial calamity, right? In a way that's like almost unrecoverable if you don't have government action and what the government does next. So in response, the government creates the Homeowners Loan Corporation, the HOLC, which was responsible, this was sort of its remit, for stabilizing housing and finance tied to housing. They used government-backed bonds to buy up bad debt and then reissue those mortgages as fixed-rate long-term loans. This is not entirely dissimilar to what happened at the end of the Great Recession, right? They
took over like Fannie Mae, Freddie Mac, all of that.
They were buying like different types of financial vehicles, right? They weren't like actually buying the loans on the homes and then reissuing those home loans in exactly the same way. But this is not entirely dissimilar to what ends up happening in 2009, 2010, right? Now, the HOLC was also responsible for issuing guidelines to financial institutions and the government itself about which areas they should invest in, which areas carried unacceptable risk. This is redlining.
I was going to say, I wonder who won and who lost in that exercise.
This is redlining. That's maybe another episode as well. Suffice it to say it was bad, right? But they were also responsible for, in addition to all of the redlining stuff, responsible for basically issuing guidelines about what terms of loans people could set. Like what terms of loans would be eligible for government-backed insurance, what kinds of loans were like classified as like safe financial vehicles. The 30-year mortgage wasn't initially dominant in terms of what kinds of things you were allowed to do, or like which ones sort of qualified as like qualifying mortgages under the FHA. Terms of 15 or 20 years were common. But then after the end of the Second World War in 1948, Congress officially authorized the 30-year loan term for Federal Housing Administration issued insured loans on new construction. And then in 1954, they expanded that to existing homes. The basic idea here being that most homes that are for sale in any given year aren't actually new construction. Most of the homes that are for sale in any given year are homes that have already existed, right? And so expanding that in 1954 is a big deal. The 30-year mortgage then grows really substantially in popularity due to its low down payments and, as I mentioned earlier, really, really favorable terms for the buyer. And by the 1960s, it had become pretty standard as the way for non-wealthy people, the growing middle class of the 1950s and 60s, to buy a home. The home ownership rate grew, hitting above 50% for the first time in the late 1950s, as people who previously couldn't buy homes bought homes. And then it stabilized in the late 1960s, early 1970s, around 2/3 of the population owning the home they live in. And it's roughly stayed about the same since then. In many ways, this was a good thing, right? We had sort of a brief discussion earlier about what exactly is the optimal rate of home ownership. There might not be one, right? But there's sort of trade-offs. But this also had unintended consequences. It involved the financial system in the housing market more instead of less. leading to the further financialization of housing that we see today, where housing is like one of the
It's your
bedrock
primary investment vehicle. Yeah.
primary investment vehicle for people and like one of the primary investment categories for banks and other financial institutions. The amount of wealth that's held in housing it's astronomical, right? To the point where you guys may have heard of Piketty's like fundamental inequality of capitalism, the idea that the rate of return on capital is higher than the growth rate of labor income. That inequality only holds true if you're considering housing wealth. If you take housing wealth out of the equation, that inequality breaks down. Just to illustrate like exactly how important this has been over the course of the last 60, 70 years or so. It's incredibly important to financial markets around the world. And because this is the financial investment vehicle, the primary financial vehicle of your average person, right? This creates a much, much more substantial incentive for homeowners to want their property values to continually increase, to go up. After all, right? Like, who wants to be underwater on their mortgage? No one. No homeowner wants to be underwater on their mortgage, paying money on a mortgage that's higher, more money than the home is actually worth. If
Yes. Yeah.
Just to make sure that we're clear for people.
Yeah, everybody understands what underwater means. Yeah. If you are underwater on your mortgage, it means that your home's assessed value is now lower than the amount of money you took out to buy the home in the first place. That's not supposed to happen on houses. Happens on cars almost automatically. As soon as you drive it off the lot, it's worth less than you paid for it. But the housing, that's not supposed to happen.
Yeah, or at least it's not supposed to happen because we have this system where everyone's primary financial investment is also their primary residence, right? Or not everyone, but you get the idea, right?
Most people who own a home, their primary investment vehicle is that home.
Yeah, and the thing is, and we'll get to this when we talk about the math a little bit later, homes are not like a great investment if you think about how much you have to pay for it in interest costs, in closing costs, in all these different like maintenance and upkeep, right? Not actually that great an investment. And so you have like an even greater incentive, right? In order to make the property value go up. And with the 30-year term, the value of your home becomes much more important to your eventual retirement. You're going to be building equity in the home basically for the course of your working life, for the most part. If you are someone who buys a home in their late 20s, early 30s, right, as sort of as the median age for a first-time home buyer these days, right? And that's been going up. But we can talk about why that is. Maybe we'll get to it. I don't know. We got a lot to talk about in this episode.
There's a lot. There's so much. This topic is so interesting because it hits on every different little bit of housing policy and discourse that we could talk about in different ways. And I think that is one of the reasons why this kicked up such a storm when it was first proposed, is everyone who has any type of interest in housing has their own reason why this is a horrendous idea.
Yeah, and we'll get to, like, I promise we're getting there. I know it's been like 20 minutes, but I promise we're getting there. The last unintended consequence, or maybe intended, but like bad consequence that the 30-year mortgage has had, is that it really increases housing demand without really doing much to increase housing supply. And because of the second order effects of people wanting their property values to go up, it's actually probably decreased housing supply as homeowners either consciously or unconsciously realize that higher supply means lower housing costs, which is just sort of like foundational to supply and demand, right?
Supply and demand. Yeah. Basically, if you don't build additional housing, it's not necessarily about the aesthetics or community like integrity or whatever. It's about, I want fewer houses, so the value of my house is higher.
Yeah. And in retrospect, I think this is kind of obvious, right? That like the idea that your home would always increase in value, outpacing inflation, would be a good investment vehicle, and that this wouldn't lead to increasingly unaffordable housing over time. Like, a little bit silly, I think, to think that wouldn't happen. But like, the people who were putting this system together, I think they maybe had like bigger fish to fry at the time during the World War II, Great Depression. It wasn't immediately obvious to them that this was going to be the case. And then on the lender side, back at the beginning of the creation of the 30-year fixed rate, banks don't really like the idea of the 30-year fixed rate mortgage.
Because they don't like the fixed rate part of it? Is that their issue?
So they don't like a few things. Banks don't like that they have to have this on their books for longer than they ideally would like to. More can go wrong in 30 years that can go wrong in 10 years, right? So the risk profile is just greater because of the time horizon. And that sort of leaves the bank with like, if something goes wrong and they have to repossess the home, that leaves the bank with a property that they might be underwater on in real terms. If people's mortgages go belly up, right? And then they also don't like the situation where they make these loans, they're getting a fixed rate of return on the principal. But if interest rates go up, then they have to pay people higher interest rates to other actors in the financial system while not getting higher rates of interest from the loans that they have previously made. I think there are two important things to note here. One is that this doesn't really work the same way in most other countries.
Yes.
Most other countries, like, mortgage terms are fixed only for a certain period of time, and then the interest rate adjusts with the rest of the financial system.
And this is one of the reasons why, if you cast your mind back to Liz Truss's mini budget in the UK, this was a few years ago, she published a budget that immediately tanked the UK financial markets. One of the reasons that that was so catastrophic to the everyday person was it changed mortgage rates on people.
Yeah.
As the financial system adjusted to that new budget plan in the UK, those interest rates changed on people, and they experienced that basically immediately in a way that we would not in the US, for the most part, experience a change in the prevailing interest rate in our own finances in almost immediate timelines.
Yeah, so there's like pros and cons to this, right? On the one hand, it's like a negative for people who are experiencing higher interest rates with limited income flexibility. On the other hand, from like a political perspective, it's a little bit more positive because you have like existing homeowners sharing the pain of changing interest rates instead of them being insulated from like political factors that are affecting the broader housing market, right? Again, this is sort of maybe another episode. We don't want to get too in the weeds on this. But the long story short is that the 30-year fixed rate mortgage is not something that exists in most of the world for purchasing homes. It's not unique to the United States, but it's certainly the most prevalent here. And then additionally, I want to note that the reverse isn't true in the United States. When interest rates go down, homeowners can refinance, and homeowners do refinance. Right?
Yes. So that does come with costs. There are costs to refinancing.
True, but if interest rates go down enough, it's like it's almost certainly worth it. People do it, right? And so you've got this situation where the 30-year mortgage is much more advantageous to your ordinary person than it is to banks. And this is, I think, fine, right? But you need to get banks to play ball, right? And so the fact that the banks don't really want to do this initially leads the government to basically say, like, look, we will insure you against the risk of mortgages going belly up, so long as the mortgage itself meets certain conditions. And that makes the banks play ball, basically. Yeah. But the result of all of this is that the United States has pretty expensive housing with relatively low housing supply and actually pretty lackluster homeownership by international standards. The United States, for instance, as we said, has around 2/3 of the population owning the home they live in. We have a roughly 430 dwellings per 1,000 people in the United States. But France, Italy, Spain, Portugal, Denmark, the UK, like our peer nations have substantially more housing. France, Italy, Spain, Portugal, and Denmark, which are the ones that we have sort of best figures for here and are sort of most clearly separate from the United States, each have well over 500 dwellings per 1,000 people. And those countries also
you're telling me we've got a system that doesn't really seem to be working for people. How have we somehow come up with something worse?
Well, we've come up with something worse, right? That's 25-minute upshot of the 30-year mortgage. It's in the federal guidelines.
Do we want to take a break before we talk about this? Somehow
No,
we came up with
I'm on a fucking roll here, Megan. So it's in the federal guidelines. It's insurable. It's something that most people have a chance of paying off during the course of their working lives. There's some trade-offs here that we've made that are like working a little bit weird, at least partly as a result of like the particular structure of the way that we do the 30-year fixed rate. That brings us to Trump's proposal, such as it is, in big
air quotes around proposal.
Yes, for the 50-year mortgage.
Not a visual medium.
And why it is so dumb. So first, let's talk about why this proposal happened. Was it a well thought out policy idea that had gone through multiple analyses, been examined by executive offices, been tested by the president's advisors to try to work out any of the kinks? No, of course
Is the
not.
Pope from Chicago?
No, of course not, right?
No, the Pope is from Chicago.
At least
This was not a well thought out policy plan.
At least it must have been something they've been kicking around for a while, right? Like it'd been in the works. Trump had just decided to post about it early, as is sometimes as sometimes he is known to do. Also, no, that's also not the situation we find ourselves in. The idea came from a minutes-long conversation with Bill Pulte, who's Trump's housing finance agency director.
So, do we know Bill Pulte's background? Is he just a donor, or
he is the grandson of another Pulte? I think William Pulte is his grandfather. He has the same name, but William Pulte founded the Pulte home building empire. They build homes. He had worked in finance and private equity and stuff. He's not a guy who you would look at his resume and be immediately this dude is horribly unqualified for this position.
Okay, I love that. I'm pleasantly surprised by this.
But he is also 37, and
Fine.
And the long story short is that while he's not someone that you would immediately look at his resume and go, dude's hyper unqualified, he's not actually that qualified, right? The standards in the Trump administration are low, but he's not one of the least qualified people Trump has ever appointed to something. But the long story short of how this proposal comes to be, according to a November 10th story in Politico, is on Saturday evening, the 8th of November, Pulte arrived at President Donald Trump's Palm Beach Golf Club with a roughly 3x5 poster board in hand. A graphic of former President Franklin Roosevelt appeared below 30-year mortgage, and one of Trump below 50-year mortgage. The headline was, Great American Presidents.
Can I just, really quick interjection? I'm sure the answer is no, but do we know how tall Bill Pulte is?
No.
Because just the visual of a man carrying a poster board almost as tall as he is really great. And we don't get to know that.
I unfortunately don't know how tall this man is. But so he arrives with this poster board. It says, Great American Presidents on the top. The next line of the Politico piece is, roughly 10 minutes later, Trump posted the image to Truth Social, according to one of the people familiar who was with the president at the time. This is how we got the proposal for a 50-year mortgage. Bill Pulte shows up, and 10 minutes later, Donald Trump announces it on his social media platform.
Looks good to me.
Yeah, literally. To put it bluntly, this is one of the worst ideas that the Trump administration has ever had that's not actively trying to be harmful to some group of people. It's a terrible, terrible, awful idea. It would have basically all of the disadvantages of a 30-year mortgage with none of the advantages, with none of the positive trade-offs that we talked about earlier. Basically anyone who knows much about housing, as you said earlier, from any angle, anything that has to do with housing finance, housing development, housing economics, everyone who knows anything hates this idea.
And I think, again, it's not just wonks, it's not just policy people like we tend to describe ourselves. I'm seeing realtors on Instagram going, don't do this.
Yeah, it's a terrible, terrible plan, right? And we're talking about people across the political spectrum, not just people I happen to agree with.
It has united us.
A lot of the people in his own administration are furious with Pulte for doing this and allowing Trump to post this and having it not go through any sort of checks, right? People are livid that this has happened because it's such a terrible idea. But for a moment, let's steelman this, as we sometimes do, right?
Yeah.
The idea behind why you would want to have a 50-year mortgage as opposed to a 30-year mortgage as a home buyer, right? The whole idea of why you would even countenance this in the first place is that it would lower your monthly payments, right? By spreading that out over the course of 50 years as opposed to 30 years. In the like realty business, real estate business, they often say, well, you're not buying a home, you're buying a payment, right? And you're locking yourself into that payment over the course of the next 30 years. This is one of the advantages that like owning your own home can have, is that like it insulates you from rent increase shocks, right? Where like basically a 30-year fixed rate mortgage is sort of like rent control for homeowners, right?
Yep.
And that you're not actually going to have. So, and this is sort of one of those like positive trade-offs from the buyer side. This is the same reason why a 30-year mortgage might work better than a 10-year mortgage, despite all of those trade-offs that we mentioned earlier. You're spreading out the payment over a longer period of time. All other things equal, that should lower your monthly payment. So what might that look like just in mathematical terms, right? Well, if you were to buy a, say, $650,000 house. I don't know why I chose this number. I just chose this number. I don't think that's like the average price or whatever, but let's say you're buying a $650,000 house at current interest rates. Let's say you're putting down a relatively high down payment. I said 20% just to make the math easier for myself while I was pricing this out.
And that used to be the standard down payment for conventional mortgages. It's gone down, but 20% used to be the standard. And I think, every once in a while, I want people to stop and think about how much 20% on a $650,000 house is and how long it would take you to save that. But anyway,
it's like, I think $120 thousand or somewhere along those lines. So you put in, say, 20% down. If you had a 50-year mortgage term, 50-year loan term, as opposed to a 30-year loan term, that would take your monthly payment, so principal and interest, excluding other fees, taxes, all that stuff, from $3,300 a month to about $2,850 per month. That's not nothing, right? That's around $5,400 a year. Like, imagine if you were to get a $5,000 a year raise, right? You'd notice that's like immediately noticeable. And so it's not entirely insane to think like, well, if you are Donald Trump and you're trying to do something about affordability, which everyone is screaming at you about, this is something that you could do immediately that people would notice in their monthly payment. It would be clear, right? So you might think, right, based on that description, based on the steel manning we've just done, well, what's the problem? That sounds great, right? Let's save everyone $5,000 a month on their mortgage or more, right? If they're in a more expensive area. Well, there are a couple of problems, right? First, lengthening the loan term, even like ceteris paribus, even all other things equal, means you're going to end up paying way, way more in interest over the course of the loan term.
Absolutely.
Thinking about those same loan conditions that we just mentioned, $650,000 home, 20% down payment, and I should have mentioned current interest rates are around 6.5%, right? Over the course of that loan term, with a 30-year mortgage, you're going to pay a slightly more than the purchase price of the home in interest. You're going to pay, and I priced this out, to be exact, $663,226.66 to be exact, at those figures. That's a lot of interest.
You're paying double the face value of your house for the privilege of having that 30-year mortgage.
Yeah. And that's like largely because interest rates are really high right now, right? Like interest rates were like rock bottom for like a decade, right? They were like 2.5%, 3% mortgage rates. At that rate, like you're paying way less in interest, right? You're paying like a couple $100,000, $300,000 as opposed to the entire purchase price of the home.
Yes. And this is one of the reasons why people say, you have these financial quote unquote gurus who say that your primary goal should be to pay off your house early. The math that they are doing to say this is basically every month you pay your house off early, it's interest you're not paying.
Yeah. And so it's not like totally insane for you to do that. No. That's again, sort of another topic of conversation.
Yeah.
So that's a lot of interest. Interest rates are high right now. But if we were to look at the exact same terms, again, $650,000, 20% down, 6.5% interest rates, that same term over 50 years, you're going to pay nearly $1.2 million in interest. And you're going to keep paying those interest costs well into your retirement at a time when you have much less income flexibility and likely less ability to supplement your income as you age, right? And you're basically paying the bank twice over in interest for that same home, which only strengthens the incentive to make the house go up in value even more. If you're paying over the course of the loan term $1.8 million for a $650,000 house, right? Like the incentives to restrict supply in order to increase how much your house is worth, they're enormous.
Yes. Yeah, absolutely.
So that's the first thing. That's the first problem.
Mm-hmm.
And that's like the best case scenario here, where we're talking all other things equal and you're just lengthening the loan term.
Mm-hmm.
But second, remember how we talked about how a 30-year mortgage was riskier for the financial side than it was for a 10-year or 15-year mortgage, right? Well, a 50-year mortgage is riskier than a 30-year mortgage. In the same way that more can go wrong over 30 years than over 10 years, more can go wrong over 50 years than 30 years. And arguably, the gap between 10 and 30 is smaller in risk terms than the gap between 30 and 50, right?
Mm-hmm.
If that makes sense, right? It's still a 20-year gap.
It's still 20 years, but yes, I can see how it doesn't have to be rational. I know we talk a lot about, rationality in banking and finance, etc. There's a lot of financial decision making, including, fancy quantitative institutions that really are just vibes. And it feels less certain to it feels harder to project what could happen in 50 years than what could happen in 30 years.
Yeah, and it's not even just vibes, right? Like just straight up from like an actuarial standpoint of like, are these people going to die having not paid off their home?
And not have that finished.
Mathematically riskier, right?
Yeah, so then, okay, so I don't know that if you want to get into this now or later, but like, okay, so are your children taking over your mortgage?
Yeah, exactly. Right? And so
Is that a component of this? Or is there an automatic sale provision if both mortgage holders die? What about if one mortgage holder dies? This also is going to have a knock-on effects on the life insurance market, because then are you saying for a lot of life insurance for parents of young children, one of the things they're taking the life insurance out for is to pay off their home so that their spouse is not solely responsible for the mortgage. This creates a whole new realm of that.
Yeah,
Then
it's a whole thing, right? Like with a 30-year mortgage, like assuming that someone buys a home at like sort of the average-ish time for a first-time buyer, like early 30s, right?
Yeah.
The loan is coming to term like at the end of your career, but still like within sort of the prime working years, right? Where you can expect that someone will, on average, right? This is like averages over the whole population. People are at their maximum earning potential in their mid to late 50s. That is when you make the most money on average. It's when you reach sort of the peak of your career.
Yeah.
And so the loan is coming to term around that same time period, right? And so you don't have to, as a financial institution, you're like, okay, this is a long period of time, but we can roughly expect that unless something goes wrong for this person, they'll be increasing their income over the course of that time period. In inflation adjusted terms, their payment will be decreasing, right? All that kind of stuff.
Yeah.
Once you lengthen that out to 50 years, the loan is coming to term, like, again, around when people are dying, right? Coming to term in your 70s or early 80s, which is like not prime working years, right? Like very few people are working full time by the time they're in their late 70s, early 80s, right? The kinds of people who are people like me and Megan who are doing PhDs and never going to leave the tenure track.
Correctly selected. I swear to God, man, this was part of my decision making and coming to do a PhD program. I'm like, sweet, a job I can camp out in until my 90s. Perfect. I'm going to be emeritusing around, having a grand old time.
But the long story short, right, is that this is riskier for all sorts of reasons, for vibes-based reasons, for like general life cycle of people's career reasons, for like actuarial table reasons. Like it's riskier.
Well, we've been talking about this. This may segue us into what I see as your next point. We keep talking about these loans as if people are going to live in the same house for 30 years or 50 years, starting in their late 20s, early 30s, and ending in their 50s. How does this affect people who are moving, who are selling a home. You're assuming that everybody buys. We're talking about the first time home ownership. What about like fifth time home ownership,
Yeah,
where you've had to move house to house,
at a certain point, you're like just never paying off this loan, right?
Yeah.
Or like
how I feel about my law school loans.
We will get into this after the point. I'm about to make a separate point, but we'll talk about this point as well. Like the longer loan terms, the equity building, all that stuff.
Yeah.
But the long story short of this being riskier for the financial institution is that because it's riskier for banks, a 50-year mortgage would almost certainly, like near certainty, have higher interest rates, because riskier debt almost always carries higher interest rates. This is just
that makes sense. The bank is insuring itself.
Yes, exactly. The interest rate, like all other things being equal, right? The interest rate that you have on a loan is representative of how risky the lender views that loan that they're making, right? Higher interest rates means that the loan is considered riskier. And back to our early scenario, where we talked about in the difference in monthly payment, increasing the interest rate just 1% from 6.5 to 7.5 is enough to almost completely wipe out the difference in monthly payment. It brings that delta, which was previously, remember, $3,300 a month to $2,850, down to just $70 a month of difference. And with that higher interest rate, you actually end up paying more like $1.4 million over the course of the term of the loan, all to save $70 a month, right?
Okay, yeah, you're saying that at the end of the day, if the interest rate goes up to cover the risk, it's not actually decreasing your payment, even though you're paying
decrease
over
the monthly payment hardly at all, right? And I should note that, like, and I am not like intimately familiar with the way that housing financing works. I'm more on the like policy econ side of this kind of stuff, the like literature that I've read. But the analysts I've seen talk about this, the like people who do this stuff for a living, they've basically said that 1% is probably the low end of the distribution of the increase in the interest rate we might see here. It could be higher, like even like 1.25% or even 1.5%, which would actually increase your monthly payment rather than decrease it, right? At which point the benefit of a 50-year mortgage versus a 30-year mortgage is just totally gone, right?
It's gone.
And so nobody would do it. Like nobody would take a 50-year mortgage term because it would be more expensive, both in terms of the amount of interest you would pay and in terms of what your monthly payment would be, right? So it's just it's just a complete non-starter. And this is the point that you thought we were about to make earlier, Megan. It takes you significantly longer to build any equity in the home with a 50-year mortgage term because you're paying more interest at the beginning if the house doesn't go up in value, which just increases those incentives for increasing home values. And if you're moving from home to home and you haven't actually built hardly any equity in the house, then you're just sort of like trading off these like 50-year mortgages over the course of your life, right? Without the ability to actually build any home equity during the time period.
It's a lot more like renting at that point. Like when you move from one apartment to another that you rent, you have your first and last for the new place and the moving costs, and there's no money coming out of your current place to help facilitate that. This is why when you're buying a home, you see so many home buyers saying things like, you have an offer with contingencies. That means that the previous home buyer has to, the person who's selling, like somebody has to sell a home in order to pay for the new home. That's where the down payment is coming from. And so if you have no money to take out, it's actually going to reduce housing mobility. And then also, as we discussed earlier, probably labor mobility as well.
Yeah. And if the value of the house has gone down, right?
Oh, then you're toast.
Then you're just totally toast, right? Because you sell the property, you can't pay off the mortgage with the value of the property that you sold, which just like, again, means you basically can't sell the home, right? And you can't move, right? If
you are stuck in a home. You are underwater at that point, and you are stuck in your home.
The thing, point about labor mobility.
Yeah. The thing that I haven't seen that I actually, again, I got into a rabbit hole on this on the basis of realtors on Instagram, even if in an ideal scenario, which it probably won't be an ideal scenario, this is actually lowering your monthly payment. So you can buy more house with that lower monthly payment. Isn't that also going to expand the potential buyer pool for houses?
Yeah.
And
So
won't that end up having the result of actually raising housing prices?
Yes, again, like the 30-year mortgage, in the best case scenario, this stimulates demand for housing without doing anything to address the legal system that we have that makes it really hard to build housing, right? And so, like, it's just bad, right? Like,
This seems like a bad fucking plan.
It's a really, really bad plan. Like, basically, even under the best case scenarios here, like, it doesn't work, right? It just doesn't work.
As we do so like to say, bad, dumb, and wrong.
Bad, dumb, and wrong. All of those at the same time.
Yes.
And so, like, all of these things that we've talking about, like, it only increases all of the bad incentives that we talked about earlier, right? And all of the negative consequences that come out of that, which in the end probably ends up making the problem of housing affordability worse rather than better. Because the fundamental, like the foundational problem here really is that we are just experiencing an incredibly acute housing shortage in the United States. And we need to solve the housing supply problem rather than just continuing to fiddle around with like financial vehicles, loan terms, like the demand side, right? Like the problem is on the supply side. And I know that like a lot of people on the left broadly are like, I don't want to say anti-supply side stuff, but they're like wary of supply side solutions to problems. But the problem here really is a supply side problem, and so it demands a supply side solution. Now with that, having spent nearly an hour talking about just how bad an idea this is
a lopsided episode, Clayton.
We're not going to belabor the point on how the solution is to embrace building housing. We've talked about that before. You can go watch many of the videos I have made on other social media platforms in order to see why this is necessary. But just to put it out there, right? The solution is you have to address the housing supply shortage. Just to put this in context, like to use some rough numbers here. There are different ways of calculating what the necessary amount of housing supply is, but I think it's helpful context to understand how much housing the United States used to build and how much we have been building for the last, call it 15 years or so, right? There are a couple of different ways to think about this. So there's the long run average of the amount of housing that we've built from 1959, when we started tracking this, to the present. And that long run average is 1.431 million homes started a year. That's private market housing starts. It doesn't include public housing construction, which peaked in the 1950s, decreased since then because of various reasons. We could do another episode on that potentially. But the long story short is that is the long run historical average since 1959 to 2025. 1.431 million homes started a year. Prior to 2008, if we cut ourselves off in December of 2007, it was 1.547 million. So just over 100,000 additional homes per year. Since 2008, it has been 1.112 million homes per year. So
housing construction never recovered from the recession.
Never recovered, right? Like never again reached the sort of long run historical average. I mean, I guess since 2020, we've been roughly right at that long run historical average, but we haven't reached back up to the pre-2008 average, right? And the reason why we say that long run historical average is maybe not the right number to use is it includes the last 17 years of lackluster housing construction as a result of the financial crisis. So if you use the difference in the number of homes that we would have been building, would have. Again, air quotes, these are rough numbers. Like, there are better ways to do this, but this is like just a context-giving exercise. The difference between the long-run historical average in the number of homes we would have built since 2008 and how much we actually built is 5.423 million homes. So about 5,423,000 homes that we would have built that we didn't. If we use the pre-2008 average, it's more like 7.4 million homes. 7,400,000 homes like housing units, right? Not necessarily just single family homes, but housing units that do not exist, that would exist if we had continued building at the sort of same rate that we did before the financial crisis. With the upshot of this being that there are actually fewer vacant units, like in absolute terms, not even just as a proportion of units out there. There are fewer vacant units today in 2025 than there were 15 years ago in 2010, despite the fact the population of the United States has grown by more than 30 million people over the course of the last 15 years.
We also tend to live alone or live in smaller configurations. You know what I mean?
Household size.
Thank you.
Right? Over the course of that same time period. To the point where nowadays we have, at least as far as I can tell, at least like using current methods for measuring these things, the lowest ratio at any time since we've been tracking this of number of housing units per household. The lowest that we've seen over the course of the last 20 years of us collecting this data using current methods. That is your housing shortage right there. Like that is the problem, is that we are millions of homes short that we would have built that never got constructed. That's the problem. That is the foundational problem.
So like, what the heck? So here's, I said at the beginning, this is the thing that baffles me. I mean, I have an ungenerous answer to it, but when it seems so very obvious that the issue is a supply shortage, why is it so difficult to increase supply? Is it just pressure from people who are financially incentivized to keep supply low to increase the value of their investment? Or is there other stuff going on? Is this just intergenerational warfare, or is there something else happening here?
So there is absolutely a financial motivation, right? The literature, I think, demonstrates this well. Jessica Traunstein has a paper in Urban Affairs Review that looks at sort of the motivations for why people oppose new housing. The one that sort of stands out in her paper, which is a conjoint design. You know what this is, Megan, but for listeners who don't, conjoint is basically you present people with two profiles. In this case, the profiles that are presented are like different housing categories, right? Like
pick this or pick that.
Yeah, different like ways of like it can be apartments. The racial makeup can be described differently. It can include parking or not. I don't remember exactly every single one of the attributes that she includes, but it's basically you have two profiles and you can pick one or the other. Right? This is useful in a lot of ways. It basically allows you to see, like, when compared to other attributes, what attributes do people actually care about, right? It allows you to see sort of a measure of preference intensity. There's a paper from 2022, Abrahamson et al., that says that the conjoint shows you votes moved rather than majority preferences because of this kind of, like, preference intensity sort of thing. And so she finds that, like, people really don't like apartments. People really don't like things that are sort of out of character, out of scale in the neighborhood. They don't like things that are expensive as well, for whatever reason. I think there's sort of weird things going on here. But the long story short is they don't like apartments. They don't like big things. And her mechanism tests suggest that one of the most important things here is property values. People want their property values to remain stable. So that's definitely part of it. There are also other things that are going on. People do seem to care quite deeply about the character of the neighborhood. If you look at, and I think like charitably viewing this, people actually do care about the character of the neighborhood in terms of the built environment, right? David Bruckman has a new working paper out just in the last couple of days, actually, with some co-authors who, I apologize, I do not remember who they are. I think it might include Chris Elmendorf, who is a law professor and political scientist at UC Davis, does a lot of work.
I don't think us mentioning them counts towards their H score, so they're probably fine with it.
Whatever. But the long story short is that this paper suggests that people do actually have really important aesthetic concerns, right? And one of the biggest aesthetic concerns that people have is they don't want structures that are like out of scale with existing stuff in the neighborhood.
If you have like a 1-story house with a like maybe bedroom in the attic kind of setup, they don't want a 5-story, even if it's like, you know, they don't want a very skinny, very tall house right next to them.
Yes, exactly. And if you look at people's like comments that they make during public meetings about housing, this also shows up, right? That people have these aesthetic objections. People have concerns around parking, right? They really don't like developments that aren't going to provide parking because they think that's going to mean that people are parking their cars like on the street, which is not a totally idle concern, right? But people do actually seem to care quite a lot about parking.
Mm-hmm.
And importantly, I think the Brookman et al. Paper suggests that these aesthetic objections are what we call sociotropic, which is a big word that means they don't actually just care if it's in their neighborhood, right? So it's not just straight up NIMBYism. It's that people don't like structures they think are ugly and don't want them built anywhere. Right. This is similar, though I wouldn't argue exactly the same, as the people that in the housing world we call bananas, the people who say build absolutely nothing anywhere near anyone. These people actually do have like genuine aesthetic objections to building certain types of housing near them. There's research from, I think his name is Adrian Pierzak and Tali Mendelberg at Princeton. And they look at like whether people have like preference for or against like affordable versus market rate housing. Broadly speaking, people at least say that they are more willing to support affordable housing in their neighborhoods or nearby or whatever than they are market rate housing. This is sort of like the like left side of NIMBYism, where people have this idea that building market rate housing in and of itself contributes to gentrification, displaces people, all that kind of stuff. I don't think the evidence for this belief is particularly good. An enormous amount of like column ink, right, newspaper ink, popular press ink has been spilled over whether the causal pathway is developers build more, neighborhood becomes more desirable, prices rise, or whether it's neighborhood becomes more desirable, prices rise, developers build more. I think the economics literature on this is much more on the side of it's the second one, right? Neighborhoods become more desirable. That causes people to start moving in. That leads developers to react by building
because it pencils when it wouldn't have before.
Exactly. Yes, it pencils.
All of a sudden, it's actually going to get you a profit to build in a particular area.
It pencils when it wouldn't have before. It makes the case that there is a development case to be made here. And in many cases, a lot of these neighborhoods are neighborhoods where it's legal to build more housing, right? They're neighborhoods that are zoned for multifamily housing. And again, this is a whole separate discussion that we don't need to spend another half an hour on, which I absolutely could. But the long story short is you have this incredible economic incentive for young professionals to seek out areas where there is housing that they can afford at a lower cost with like similar access to their workplaces. You have neighborhoods that are like not as Tony or cool or chic as like the most expensive ones, but aren't really that much more dangerous. They don't have like poor access to services or restaurants or grocery stores or whatever. They're just less expensive because of the historical legacies of the redlining and all that stuff we talked about earlier, right? And so people start to move into these neighborhoods. They realize that they're not actually that dangerous or whatever. There's this sort of urban discovery process. In many cases, urban pioneers, they call them the urban pioneers, the first wave gentrifiers, they might actually outright have a preference for diversity. There's a lot of literature on this, but the long story short is that is a signal that then developers react to. And the challenge is that, like, if you don't build additional housing in these neighborhoods, that doesn't make the gentrifiers vanish. It just means they then further contribute to gentrification.
Because they're pushing people out of the existing housing stock rather than the new stuff.
Right. But you have this situation where people see the neighborhood getting gentrified, they see new housing going up, and so they perhaps make that logical leap that the new housing is what's causing the gentrification in the first place, right? So those are three things, right, that are, I think, well supported in the existing published literature, or at least I can't imagine that Brookman, that paper is, the Brockman paper is not going to be published somewhere eventually, right? I also have a paper that got an R&R at PSRM, Political Science Research and Methods, earlier.
Hell yeah.
I need to do the revisions on it and all that jazz.
Dude, holy shit.
The upshot of my paper is that there is a non-trivial percentage of the white population that has explicit racial hangups about building new housing.
Like overcompensation for historical inequity, or
no, the opposite.
the opposite way. Shit.
The way that I measure this is with a list experiment. For those who don't know, a list experiment is basically you have an experimental randomization. You present half of people with a list of like 5 things that are relatively unobjectionable. You say, how many of these do you agree with? In my study, this was like, here are some reasons why people might oppose new housing. It was like about property values, neighborhood character, parking, all that kind of stuff, school quality, right? Those things. And I basically say, how many of these things do you agree with? I am concerned about this because I am worried that I'm like concerned about new housing because I am worried it will worsen these things. The second list I present them with, not the same people, a different group of people, experimentally randomized to be identical on average. And you present those people with the same 5 things, but you add a 6th thing at the end. And it says, the one that I wrote in this study is, I am concerned that new housing would cause non-white people to move into my neighborhood. So I didn't hide the ball at all. I said it really explicitly.
With your whole chest.
With my whole chest. Like, if you are, and the basic premise of the list experiment is that if people in the sensitive list group agree with a higher number of things, then the only logical explanation is that some of them are choosing that because they agree with that thing, right? Now, there are reasons that there are potential problems with list experiments. I think I did my best to address them in the design of the experiment. I feel relatively confident in the results. The reviewers were a little less confident in the results, but I thought that they maybe misunderstood a little bit of what I was doing, at least for a couple of them. But the long story short, the upshot is that my results are consistent with roughly 20% of the white population agreeing with that 6th statement at a nationwide sample of the white population.
Wow.
Now, there's, people can be concerned about anything and not actually really let that affect their decision making, right? They can think to themselves, they can admit to themselves, yes, I am concerned about this, but I'm gonna not like use that as a reason to oppose this anyway, right? It's a slightly different question than some of these other studies have asked, where they've asked like explicitly, do you support this development, or like, which one are you going to choose, right?
You're trying to get at this. They know enough to know that they can't just say, I don't want minorities in my neighborhood.
Yeah. So, I mean, the long story short of this is like, there is reason to think that my results don't necessarily mean that 1/5 of people who show up at any given city council meeting don't want Black people to move into their neighborhood, but they are willing to admit that they're concerned about it, right?
Okay. Right. Is this, I mean, maybe like it's a 3D chess thing, like I'm not racist, but I think the people I would want to buy my house might be racist, Maybe,
right? The list experiment I tried to design in such a way as to like have all of the other things in the list be the things that you would think are like connected to the sort of like statistical discrimination, right?
Mm-hmm.
Where like, yes, in theory, you could have these concerns statistically speaking because other people are going to think that having non-white people in the neighborhood decreases all those things. And so putting all of those things at the same time as you put the explicit racial thing should help that. And then also there was a whole deal. There's another part of this paper where I present people with like profiles. It's like a factorial experiment, which is a little bit like a conjoint. We don't have the time for me to explain all the methods in depth.
But like the upshot of all of this is there are a lot of reasons why people don't want to build housing, and that's why we're maybe not doing the thing that actually will solve the problem, and why we're instead tinkering around with financial instruments that don't fix it.
Yes. At all. And so I think that, and to sum all of this literature up, right, there's another recent paper in the Journal of Economic Perspectives by Chris Elmendorf, Clayton Nall, and Stan Oklobjiha. I don't know how to pronounce his name. I've never heard it said out loud.
Sorry, Stan.
We'll figure it out. I've talked with Stan before. I'm sorry that I don't know how to pronounce your last name, Stan.
You're at a point where you can't say, Stan, how do you pronounce your last name?
I mean, I probably could. I've never actually met him in person. Like, I've talked with him. Anyway, long story short, their paper suggests that people don't recognize or don't understand that building more housing brings down prices. The economics literature, I think, demonstrates this quite strongly. Like, I think this is a relatively strong finding in the housing economics literature. There's some disagreement as to exactly like how to get more housing built, right? There's like different papers out there that sort of compete over whether or not zoning restrictions are actually doing most of the work. Some of them say yes, some of them say no. The ones that say no, I think, are not quite as strong, like, because they only look at single family homes, whatever. Again, this is sort of extra methodology stuff. But the long story short is that for every other type of supply shock that they present people in this paper, people are like, does increasing all of these supply of these things make the price go up or down? Most people are directionally correct that increasing the supply of various things makes the price go down, right? For housing, people are directionally wrong. People think that building more housing makes housing prices increase on average, which is not right. It's not correct, I think, given the bulk of the economics literature on this. And so that's another reason why we haven't been building more housing, right? Because you've got all of these incentives for people to not build housing, right? And then you also have the fact that when you ask them about it, at least in like a sort of experimental setup type way, intended to get at their actual opinions, they don't believe that building more housing will decrease housing prices. They are directionally wrong about it. And so the sort of countervailing pressure where you might think like, oh, well, people have all of these other incentives, but they recognize that it is useful to increase housing production because we need to. That countervailing pressure isn't there for a lot.
We don't understand that.
We just don't understand.
So do you have any idea how much it costs to buy a billboard? Because I feel like that's the direction we're heading here.
No.
Okay.
For a preview of my job market paper here, we're doing a large field experiment. We're going to see what messages can sort of mobilize renters who broadly do support building new housing as opposed to homeowners who don't. It's just, again, there's 2/3 of homeowners, 1/3 of renters, right? How we mobilize, or how renters who already support building new housing can be mobilized. The title of this paper is going to be From Preference to Participation, which I thought was really clever.
Snappy.
But so anyway, long story short, see that in a year and a half, right? But the long story short of the episode is 50-year mortgage, terrible fucking idea, absolutely horrible. Solution is to build more housing, and there are lots of reasons why we aren't building a lot of new housing. And we talked about the political reasons. There's economic reasons as well, but that's maybe for another episode.
Another episode. We've teased like 5 other episodes
I don't
in this.
even remember all of them at this point. Like Megan, she's like,
fortunately, we've been recording. We'll go back. I'll take some notes, and we will bring you guys much more housing content in the future. But I don't know what we're going to do next. But Clayton, I think you made a very good point that maybe we should be spacing the housing stuff out.
Every time,
not a single issue podcast.
Every time we do one of these housing related episodes, I get people from like my real life messaging me and being like, dude, like, what the hell?
Get a damn hobby? Is that this is it? This is our hobby.
It's, yeah, honestly. I mean, yeah. We'll probably do like we'll do the well-regulated militia episode next, maybe.
Yeah. I think we've got one that we want to do on guns, which shouldn't upset anyone.
No one will do it.
And then we've teased at least 4 more like culture episodes over the last few. So again, I will go back and listen to all the good ideas we had live on air, and we'll come up with some good stuff. I don't know how much recording we're going to be doing coming into the holidays. So to the extent that we don't talk to you guys for a bit, have a happy whatever it is you celebrate in December.
Happy whatever it is you celebrate in December. Great slogan.
You're welcome. We are inclusive at Reject Modernity, Embrace Tradition.
All right. Well.
But until we record some more episodes.
Remember, the 50-year mortgage is a terrible idea. Don't do it. And if it becomes legal, don't get one. And we will see you guys on the next one.